The subject of inflation is definitely one of the topics we discuss with portfolio managers. And one of the issues for the equity market is that, generally speaking, equities do better in a low inflationary environment as compared with a high inflationary environment. And alternatively, falling inflation generally better than rising inflation. And so clearly, the things you just mentioned would be consistent with higher inflation, this whole idea of transitory, how long will this last? And if we were to put a marker in, let's say, the fall, September, October, inflation staying high from now through then would be a bit of a headwind for the equity market. And that's consistent with our forecast here, with around 4,300 for the S&P 500 at the end of the year. So basically, over the next several months, Carl, this high inflation and potentially rising inflation is definitely a concern and probably a headwind for the equity market.
But in the long term, David, your group has said you'd had a note this week entitled "Why the Economy Will Not Overheat." You think we might overshoot potential, but only briefly. I would argue some of your peers on the street actually have a more hawkish view about inflationary pressures beyond, let's say, the next few months.
Well, the issue, of course, is the definition of transitory. How long does that last? And the view here from Goldman Sachs in the macro area is that it is going to be a more transitory experience for several months. We're definitely having some measurement reasons why inflation is very high, sort of base effects from last year, questions about labor availability, the issue of extended unemployment benefits, things like that are definitely, at least in our interpretation of the data, supportive of higher inflationary readings. But if you do some adjustments, perhaps it's less underlying inflation then would be more of a concern. So our view on the equity market side is that inflation will be receding, and it's about earnings ultimately, not about valuation. If you break, Carl, the subject of inflation into two pieces, and you think about the earnings impact of inflation and then separately the valuation impact of the inflationary backdrop. And so from an earnings point of view, higher inflation, generally a positive from a revenue point of view, sort of mixed on the subject of margins. We'll get to taxes in a minute, but broadly speaking, inflation somewhat supportive of higher level of earnings. That is our forecast. And then on the valuation side, the question is about whether higher inflation leads to higher interest rates. And our view is, as you just pointed out, interest rates have been relatively stable. Could argue surprisingly stable, kind of in that 1.5 to 165 or so range on the 10-year U.S. Treasury. That's consistent with the equity market staying valuation-wise around these levels. So at 22 times earnings, it's not a story about valuation. It's a story about earnings. And the question that we focus a lot of attention on is taxes. And what is that impact likely to be? And I would argue that there's negative earnings revisions potential as you go into the back part of this year, looking into 2022. I think that's a significant issue with portfolio managers.
All right, so how should investors be positioned for all of that? I mean, you're talking about near-term headwinds for the equity market. You're talking about tax implications later on in the year. I mean, we could debate whether we're poised for another taper tantrum in the middle of all this as well. What do you do?
So, Morgan, I think we think about it as where's some value in cyclicals right now. The economy is definitely getting better. All the data would suggest that. The reopening index at Goldman shows 7 out of a scale of 1 being full lockdown, 10 being reopening. So we're kind of moving towards a full opening. That would suggest cyclicals continue to do better. That's some of the industrials. You had earlier a guest on from Honeywell. That kind of a business likely to do better in this environment. If we look out a little bit later in the year, the transition towards more growth is likely to be the case. So I think of the handoff of value cyclicals now and more of the longer-term growth in later in the year, looking into 2022. And I think the way to think about that is the duration. What average time in the future do you want your cash flows? You want your cash flows sooner now, and then later in the year, we'll look at the growth as the economy gets to more normal growth prospects. That's where the faster growing, more technology, generally focused areas are likely to do better.
Shepard Smith here. Thanks for watching CNBC on YouTube.